Welcome to the MUFG Global Markets Podcast. I'm John Cook, and I'm joined today by Takahiro Sekido, Chief Japan Strategist for MUFG. It's Tuesday, March 8th, 2022. Welcome back to the podcast, Sekido-san.
Good to be back.
Always good to have you. So as you know, as everybody knows, the market has been extremely volatile as of late, as the war in Ukraine has persisted for far longer than any of us had hoped. Sekido-san, given recent price action and recent developments, I'm curious what your outlook for yen rate and basis is for the month of March and why.
Okay. This week, Japan stocks marked a year-to-date low. Dollar-yen basis is volatile, amid mixed trading by Japanese and foreigners. Downside for dollar-yen has been limited, even despite the risk of sentiment in the market reflecting a surge in oil prices, risk aversion, and fiscal year-end factors. At the same time, all three factors have weighed on JGB rates. We expect both Japanese and foreigners to rebuild their JGB positions. The BOJ has also been reducing the TDB purchases, and foreign investors appear to be monetizing yen basis arbitrage opportunities with TDB asset swaps. In dollar terms, JGB asset swaps have been attractive, mainly because of the widening yen basis. The main battlefield for JGB investors has shifted from the BOJ's 0.25% upper YCC limit to JGB asset swap opportunities after yen basis widened. The end of March brings the end of the Japanese fiscal year. We expect the front end of yen basis to widen with dollar-yen basis term contracts over the end of June jittery. The Ukraine crisis has caused the long end of the yen basis curve to tighten as Japanese companies and investors put off longer-term dollar funding via yen basis.
You know, it's amazing how quickly things change. It wasn't that long ago that you and I were doing a podcast, about the BOJ's unlimited fixed rate buying operation, and here we are. Back 10-year JGBs are back to 15 basis points, and everything's moving in a crazy risk-off way, except for dollar yen, as spot dollar yen remains incredibly stable. Despite all the reasons that you highlighted before. So switching topics, but still relevant in terms of understanding market dynamics. How is the supply and demand of yen funds, as shown by the Japanese Ministry of Finance's fiscal fund flows, impacted the market?
Government deposits at the BOJ rose to 33 trillion yen at end February, but the MOF does not plan to cut issuances of TDBs for March and will maintain April TDB issuances at the same level. This reflects the MOF's conservative funding decision. The MOF projects net general fiscal spending of 13 trillion yen in March and increased the TDB issuances by 4.3 trillion yen year over year. This has helped keep pressure on the front end of the JGB yield curve. The Ukraine crisis is deepening, and past crises have triggered widening in dollar-yen basis. However, the current reaction by dollar-yen basis is different. Foreigners have been getting more trading experience with JGB asset swaps in recent years. They know that TDB asset swaps are useful for managing surplus dollar funds, so we expect a neutral bias for yen basis for March.
Yeah, that's an interesting point. I mean, despite all these signs of funding stress and various risk proxies going vertical, there still is a huge glut of dollars across the globe. There's over 1.5 trillion sitting in the Fed every day. So I suspect you're right. Any widening would quickly be arbitraged by JGB asset swap buyers. Let's see. So moving on, the Japanese Ministry of Finance recently released its international transactions and securities data for the month of February. Always enlightening. Why don't you take our listeners through what both Japanese investors and foreign investors were doing in international bond markets during the month of February.
Okay. In February, Japanese banks unloaded a huge 2.9 trillion yen of medium to long-term foreign bonds. Against that, Toshin investment trust companies, mainly retail investors, bought a net 103 billion yen of foreign stocks and investment fund holdings. Pension funds, trust banks, sold a net 322 billion yen of medium to long-term foreign bonds and 194 billion yen of short-term foreign bonds. This selling helped cap upside for dollar yen. Foreigners unloaded a net 23 billion yen of Japanese securities, driven by a net 872 billion yen of stocks and investment fund holdings. Against that, they net bought 620 billion yen of short-term bonds and 228 billion yen of medium to long-term bonds. Early in February, Japanese and foreigners alike reduced their bond positions. Then, from mid-month, as the Ukraine crisis conflagrated, foreigners turned more active buyers of JGBs and sellers of Japan stocks, while Japanese investors bought more alternative assets.
So heavy selling of foreign bonds by Japanese investors, and although net selling of Japanese bonds by foreign investors much lower, as you point out, that sort of changed, as in kind of to our previous discussion, it all hinges on quick arbitraging of JGB asset swap opportunities. So as we do, why don't we wrap things up with your outlook across the markets of yen rate, spot dollar yen, and yen basis?
Amongst the G10 currencies last week, Aussie dollar and Canadian dollar rallied as resource prices rose. This reflected investors' concerns about the crisis in Ukraine, and Swiss franc, yen, and dollar also followed. Euro and other European currencies weakened, a reflection of the region's economic relationship with Russia. Currently, the uncertainties surrounding Ukraine are not clearing. Over the near term, we expect buying of resource country currencies, followed by dollar and yen, to prevail. We change our view for dollar yen to bullish bias, with trading in a 2 yen range between 114.50 to 116.50. The yen swap rate curve has declined, especially in the belly. Downward stress on the yen rates reflects the turmoil in Ukraine. Japanese investors will inevitably put their yen funds into JGBs. Demand for JGBs will also grow among foreign investors once interest rates in the US are hiked, and speculation about a faster pace of the hikes takes hold. That said, the MOF plan to continue issuing JGBs, so yen rates will likely stop falling. We now expect a neutral bias for yen rates rather than a downward bias. While the yen basis curve showed tightening for 3 months, other durations of the front end and through the belly widened slightly. The MOF's weekly securities flow data for February 20th to 26th showed that the Japanese unloaded a net 442 billion yen of overseas securities, while overseas investors net bought 201 billion yen of Japanese securities. Japanese investors net bought 110 billion yen of foreign stocks and investment fund holdings, but remained a net seller of medium to long-term foreign bonds by 332 billion yen and short-term foreign bonds by 219 billion yen. Overseas investors acquired a net 827 billion yen of short-term Japanese bonds, but unloaded a net 223 billion yen of medium to long-term yen bonds. Overseas investors have unloaded Japan stocks and investment fund holdings in net term for 5 straight weeks. Now, including by 402 billion yen on February 20th to 26th, The weakness of Japan stocks have been striking. Over the near term, underlying demand among Japanese companies will encourage Japanese banks to be conservative in their dollar asset funding in view of end March and end June. But at the same time, appetite for JGB asset swaps among foreigners will likely go further. We expect a neutral bias for yen basis.
Okay, great stuff. So bullish on dollar yen, but neutral on JGBs and basis. Great stuff as always, Sekido-san. And for our listeners, I'd encourage you to check out his research. And if you are not getting Sekido-san's JPY, various publications, cross asset, cross view, et cetera, please don't hesitate to get in touch with Sekido-san or myself directly. Thanks again, Sekido-san.
Thanks for having me, John.
And thank you for listening to the MUFG Global Markets Podcast. Rate, review, and subscribe on Apple, Spotify, or wherever you get your podcasts. And to reach out to your MUFG sales rep for any further information. Check back soon for more insights from the Global Markets Research Team.